With international crude prices rising and India's trading deficit widening, the economy is badly impacted. Why has the rupee been falling? What does this mean for imports? What about exports then? How is this situation affecting the overall economy? So what is the ideal value of the rupee against the dollar? GS Paper 3, Indian Economy. In this video, you can find detailed answers for all the above questions. The above article has been retrieved from indianexpress.com, dated May 25th, 2018. What is the context about? The rupee has fallen 5.2% in the current financial year from close to 65 on March 28th to an 18-month low of 68.42 against the dollar on Wednesday. As worries for importers, travelers and even students rise steadily, analysts are watching the currency's steady march towards the 70 mark as international crude oil prices continue to rally and foreign funds flow out. Why has the rupee been falling? There are three major reasons. The rise in crude prices, portfolio outflows from India due to the selling of stocks, especially by foreign portfolio investors, and a growing anticipation of interest rates rising in the US. As oil prices rise, India's trade deficit, excess of imports over exports will worsen, which can in turn impact the current account deficit. As the US Federal Reserve raises rates further, which is bound to happen, FPIs will prefer to invest in their home country as the arbitrage gain while investing in India and emerging markets will decline. What does this mean for imports? Importers will be hit as the cost of getting goods or equipment into India will increase. While the rupee weakens, importers, especially oil companies and other import-intensive companies, have to shell out more rupees to buy an equivalent amount of dollars. In this sense, a weak rupee can act as a kind of import tax. For the oil sector, it is a double whammy, as the rise in crude prices and the decline in rupee value add to retail fuel prices. Margins of oil companies will come under pressure. What about exports then? Exporters, especially software exporters, stand to benefit as they get more rupees while converting dollar export earnings into Indian currency. This is expected to boost exports, which have been showing single-digit growth. How is the situation affecting the overall economy? The fiscal and current account deficits are interlinked. When fiscal deficit is high, government borrowing rises, leading to higher interest rates. However, when foreign funds starts flowing in, the rupee strengthens and exports become more expensive. Crude prices are expected to rise further this year, and imports are expected to grow by at least 14%, says a note from SBI Research. This is bound to enlarge the import bill and push up the trade deficit, which will in turn add the CAD and push the FY19 figure to 2.5% of GDP. So what is the ideal value of the rupee against the dollar? It's difficult to say. The RBI, which manages the rupee's movement, says that it never fixes a value. Rather, it facilitates the orderly movement of the currency. The RBI buys dollars from the market when the rupee strengthens and sells the US currency when the rupee weakens. It tries to maintain a balance by taking into account all external and internal factors.